now we can see accounting process. Okay, accounting process, that is transaction. First is transaction. We are getting the transaction, and we are collecting the source documents of that particular transactions. Okay, and thereafter we are recording into the journals. These three these three are recording process. Okay, these two are collection process. Okay, so we are receiving the transactions, we are getting the transactions are taking place, and we are collecting the source documents. Then from the source documents, based on the source documents, we are recording the journals, right? From the journals, it comes to the ledger. Okay, ledger, and from the ledger we are preparing the trial balance. From the trial balance we are preparing the financial statements. Okay, so first of all, we receive transactions are taking place, and based on the transactions we are collecting the relevant documents of that particular transactions, and thereafter we are recording those source documents on the in the journals, and based on the journal we are passing the preparing ledger. Based on the ledger we are preparing the trial balance, and based on the trial balance we are preparing financial statements. Okay, so have you understood all? And we will say, what is the transaction? Transaction, we can say, we we are selling the selling the goods. That is the transaction. We are purchasing. We are purchasing. That is the purchasing activities. We are purchasing what you call um, mm, what we can say, purchasing the stationery. Okay, purchasing the stationery. That is the transaction. Okay, purchasing stationery. Stationery. That is the transaction. Sales also, selling goods. Goods. It is a transaction. Receiving cash. Cash from debtors. That is also uh, what you call transaction. Those are the transaction. For an example, now you would have got an idea what is the transaction. Okay, how we ascertain the transaction, right? We are selling the goods, we are purchasing the stationery, that is a transaction. We are selling the goods, that is a transaction. We are receiving the cash, that is the from debtors, that is a transaction. We are payment payment of cash, payment of cash, that is also one transaction. These are the different transactions. Okay, returning the goods, purchase goods, returning, because um, we are selling the goods to X. Okay, he is not satisfied with the quality of the goods which we have sold to him. So he has an option to return the goods back to us, because on the basis that quality is not good, or that particular goods are not uh, fit with the requirements or something, based on some reasons. Okay, that also coming under transition. So all those are transitions. Okay, now we come to the second issue, source documents. These are the transactions. Then what are the source documents? Source documents, cash receipts. Okay, if you are receiving the cash, you have to issue the receipts, cash receipts. Okay, so cash receipts, payment voucher. If you are doing payments for the purchases, you have to prepare the payment vouchers. Okay, through voucher only you have to do the payments. Okay, so that is the source document. So in detail we can see later on how we have to prepare the payment vouchers, how we have to prepare the receipts. Okay, and purchase invoice in the sense, this source document we will receive when we do the purchasing from the third party, second other party, right? We are purchasing furniture, in the sense the invoice will be issued by that person who is selling the furniture to us. That is the purchase invoice. Sales invoice, when we are making the sales to the other party, third party, then we have to issue a document called sales invoice. So that is the source document for our sales. Debit note. Debit note in the sense, if we are not satisfied with the purchased goods, right? If we are not satisfied with the purchased good, we are issuing the we will return that purchased goods to the person who has supplied to us. Okay, for at that time we will raise debit note, right? Debit note, that is based on goods return outwards. And credit notes also like that. If we are making a sales, and the person is returning the goods back to us, at that time we are issuing the raising the credit note. Petty cash vouchers, for the small expenses we used to uh, use petty cash vouchers for those small payments. Okay, and third one is journal vouchers. Journal vouchers called we use for the rectifying some errors and some unusual transactions. Okay, for that we used to use the journal vouchers. These journal vouchers not for the cash transactions. For the cash transaction, we do not use the journal vouchers. Okay, so now source documents also we have covered. Okay, you know now what is the source documents, what is the transaction. Okay, we know we have this, we have gone through the transaction. Now we have received the source documents. Now we are going to record it in a journal books or book set of books of accounts. Okay, in that set of books we say journal entries, journals. Commonly we used to say journal, not the journal entry. Journal entry is something different. Journal voucher is something different. This is journals. Journals. This is receipt cash book. We used to say receipt. We can say receipt cash book or receipt journal, in which we used to record the cash receipts only. In receipt cash book or receipt journal daybook, we used to record the only the cash receipts. And in the payment cash book, we used to record only the payment vouchers, payments, whatever cash payments we have made. Payment cash book, payment vouchers. We can say like payment journal, right? Payment journal also there, payment cash book also there, payment receipt cash book also there, receipt journal also there. Whereas in the receipt journal, we used to record only the credit sales, not the cash sales. Okay, cash sales will be recorded separately. And purchase invoice. Based on purchase invoice, we used to record it all the purchase invoice in the purchases journal, right? And based on all the sales invoices, we used to record it in the sales journal. All the debit notes will be recorded in the return outwards journal. Okay, all the credit notes will be recorded in the credit inwards journal. All the petty cash vouchers will be recorded in the petty cash journal or petty cash book. Next one is journal voucher. Journal voucher will be recorded in the general journal. This is general journal, where unusual transactions, errors, omissions can be rectified through this journal vouchers. That is the general ledger journal. Okay. So now we have covered journal also. Based on this journal, transaction taking place, and thereafter we are gathering the source documents for that particular transactions, and based on the source documents we are recording it in the journals, and based on journals, from journals we are recording it in the ledgers. We are updating the ledgers from journals. Okay, all these recording process takes place in the ledger on the basis of double entry. Okay, on the basis of double entry. So we can see what are the ledger accounts available. In ledger accounts, asset ledger account is there, liability ledger accounts there, income accounts there, expenditure accounts there, equity accounts there. The relevant account headings will be posted to be these under mentioned headings. Okay, so ledgers. So we are recording ledgers, updating ledgers based on the journals, and from the ledger balances we are preparing the trial balance. Okay, trial balance normally we used to say summarized form of the ledger balances. Okay, so all the ledger balances are summarized and mentioned in the prepared in the trial balance. If you go through the trial balance, you know what are the ledger accounts are available. Right? All the ledger balances will appear in the trial balance, vice versa. Okay? And from the trial balance only, we used to prepare the financial statements. From the trial balance, we used to prepare the financial statements. What are the financial statements? That is profit and loss account, or otherwise you can call income statements. Okay, profit and loss account or income statement you can say. Second one, balance sheet. Okay, so one is profit and loss account and balance sheet. Third one is statement of changes in equity. that is SOCIF, Statement of Changes in Equity. That is third one. These are the financial statements we used to prepare. Normally, the companies used to prepare, and that's all. So we have seen transactions, and based on the transaction, we are gathering the source documents for that particular relevant transactions, and based on the transaction, we are recording the journal entries, preparing the journal entries and recording in journals. Based on the journals, from journals we are posting, or from journals we are posting to the ledger accounts, and summarized ledger accounts will appear in the trial balance. Based on the trial balance, we are preparing the final statements. Now, I feel you people would have got the correct picture of this financial accounting process. Okay, so next one we can see elements of financial statements. Okay, we we just go through it, and wherever we are teaching all the particular subject, we can uh, teach in learn in deeply. Now to have a rough idea about this, all these matters. Okay, elements of financial statements, in the sense final elements of financial, there are only five elements consist in financial statements. Okay, only the five elements consist the financial statements. That is, one is revenue, and number two is expenses. Okay, and number three is asset, and number four is liability, and number five is equity. Okay, these five elements only will appear in the financial statements. These are the main category, main headings of the financial statements. We have seen in the previous chapter, we have gone through about what is the definition of revenue, what is the definition for the expenses, what is the definition for the asset, what is the explanation for the liability, and what is the explanation for the equity, right? If you are coming directly to this class, this chapter, please go through the previous chapter to get to know about these five elements in detail. Okay, here we have to see these two, revenue and expenses, coming to the profit and loss account, that is income statement. Right? These two aspects will appear in the profit and loss account. Right? These two only consist in the profit and income statement or profit and loss account. Asset and liability, equity. These three will consist in only these three only consist in the balance sheet. Okay. Now we have summarized. Now you have an idea. Revenue and expenses will go to the profit and loss account. Assets, liability, and equity will come to the balance sheet account. Okay. So you would have got a good idea about today's lesson. And if you have any queries, you can post your queries. You can ask all your queries in my email. Uh, I will go through one by one, and when time permits, and I will reply to you all, and I will clear all your doubts. Okay. Thank you very much for watching this video, and we will meet you in next class chapter. Okay, thank you.